Rule number one for me in real estate is you make your money when you buy. I can't emphasize that enough. If you bought in 2011 and you paid, let's say, 20% more than the property was worth, then the market have corrected since then and you're doing just fine today. But if you'll buy today and you pay 20% more than it's worth and the market turns on you next year, the market is going to take your head off.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 165. My guest today, Joseph Gozlan, is a multifamily investment specialist with a portfolio of over 500 units in strong secondary markets in Texas. Joseph is also a former lieutenant in the Israeli Defense Forces and has over 17 years of leadership experience in the software industry, which helped him sharpen his business and analytical skills as well as his big picture perspective. He's also a fascinating guy with a lot of creative big picture ideas that he'll be sharing with us today. Joseph, thanks for being on the show.
Thanks for having me, Brian. Appreciate it.
Tell me about your first investment and just where you come from. I mean, you were in the Israeli Defense Forces?
Yeah, so I was born and raised in Israel. And, back home, the path for almost everybody is you go to high school, then military, then university, and the career after that. And it's somewhere along that path after the military and we were in the university, I met my wife in the military and then we stayed together during all those years. And I just graduated from the university, got my first real job, right? And we were renting like a 1-bedroom apartment somewhere. And we had plans on getting married and all that. So we got married and we bought a bigger apartment to live in, right? Back home, everything is more urban, right? Think Brooklyn, New York kind of style. Not a lot of single families everywhere. And it was a larger 4-bedroom apartment and it was just the two of us. We didn't have kids back then. And, it just happened to be after we read Rich Dad, Poor Dad and all that. So I was looking at my wife and said, okay, maybe we just rent it for a year or two until, we're ready for that. And then we'll move in. So it's kind of like an accidental landlord. But that once you start seeing the benefits of being a landlord and you see that income that comes in and covers the mortgage and then there's more left after that, you kind of get the real estate bug. And I guess that's where everything started.
What's it like investing in real estate or owning an apartment rental in Israel compared to owning rental property in the United States?
So, first of all, it's a different mentality back home. It's more of an ownership mentality than a rental mentality. So you're kind of expected to, when you start your life and you get married, that you'll buy your own apartment and you move into it. So being a landlord is not something super common, but it does exist. And then you own one apartment or two apartments in a building, and that's it's like owning a condo here in the U.S. pretty much. And then different market has different traits to it, right? So over here, the landlord is responsible for the taxes, the property taxes, and all that. In Israel, it transfers over to the tenant. So it's just a little bit different, but it's definitely a lot less yield than you can get here, just because the market is more expensive. It's very similar to urban environments like New York, Miami, LA, Seattle, and so on. So there's not a lot of good returns being a landlord back home.
So you're paying more for the property or for the apartment, which makes it harder to cash flow?
Exactly. So just like the major cities I mentioned, it's more for appreciation than it is for cash flow.
So how did you end up in Texas owning over 500 units multifamily?
Well, it didn't happen overnight, that's for sure. We relocated here in 2007 through the software company I was working for back at the time. And we had the real estate bug already, so we kind of looked around, and it was 2007-8 when everything was going up in flames pretty much around us. So I told my wife, look, it's got to be the best market of our lifetime. And she realized that immediately with me. So we both got licensed because, again, we didn't know anything about how real estate works in the United States, right? So we got licensed in Texas as real estate agents, which we still are licensed, both of us, and learned the system, got access to the MLS. And then when we realized the market is there's not going to be another opportunity like that anytime soon, we sold that apartment back home and moved the money over here and started investing here in Texas. So we started with a duplex, and then another single, then life happens and kids happens and everything was going on. We did a few more transactions and singles since then, but in 2015, I kind of found myself writing about $45,000 worth of checks on just one property. Right?
One of your singles?
One of my singles. And we had foundation issues, which in North Texas is very common. And when you raise when you raise a 1978 property, then all the soil that was holding the cast iron plumbing is shifting, and that cast iron plumbing is just crumbles.
Uh-huh.
So we had to do foundation, we had to do plumbing. The same year we had a water heater burst that took out the flooring. We had a garage door go out. We had a hailstorm, which we had to pay deductibles on. It was just a very unlucky 6 months for that property. And that was just one property. I had another property that needed a fence. That's about $8,000. We had another property that needed an AC unit. That was $3,000. And I'm looking at my wife, and that's not sustainable. How many people can yank out $50,000, $60,000 out of their bank accounts to start paying for all these little things?
Yeah.
So,
and what kind of cash flow were you making on these properties? Because you bought them at the right time at what I would assume is a very good price. Were you cash flowing enough to cover these expenses?
Well, yes and no. Right. So when you get a property and it's a really good deal, you get maybe $200-$300 a month in cash flow. Right. So it's great. And cash flows for a year, then another year maybe, and then something big happens and that wipes away years of cash flow. So I was lucky enough or smart enough or cautious enough, call it whatever you want, that I've built this capital reserve account on the side, knowing that every once in a while I'll have a water heater, I'll have a fence, I'll have a AC unit. And that's where I paid all these bills from, because I was ready for it. But I know a lot of investors that are not ready for it, and they just use that $300 a month or $200 a month to, for their own living expenses. And suddenly they're looking at $8,000 bill and they don't know what to do with it.
Yeah, it's a messy process. I mean, you run into problems, and you can never anticipate when those problems are going to happen.
Yeah, and as a single family owner, you have 100% of the risk, right? If you have a vacancy, then you pay the mortgage, and you pay the real estate agent to release it for you, and you pay for the homeowner's insurance and the homeowner association and the electric bill. It's all out of your pocket, right? And that's really where we had a moment back then in 2015 that said, that's not sustainable, so what is? And I'm an engineer. I'm wired like an engineer. So I started researching, and I researched everything you can think of, both real estate and non-real estate. And I landed on multifamily, and that's what we've been doing since then.
Yeah, well, it's interesting you didn't just throw in the towel and say, you know what, the market's good, let me just sell these properties, get rid of them, and go back to my W-2 job.
Well, surrender is not an option.
So that was not something you could do at that point, huh?
No, because you look at, like I said, I researched everything. real estate and non-real estate. I looked at stocks, day trading, forex trading, commodities, oil and gas, gold and silver. I looked at everything. And we can run one by one. I'll tell you why I decided it's not as good as multifamily. And I'm not saying all these things are not good, is because I know a lot of people that makes a ton of money in forex and a lot of people that makes money in day trading. But for me, I'm a little bit of a control freak. When I say a little bit, I mean a lot. So I need to know that I have control over the value of my investment. Because if you look at the stock market, and that's what most people are doing, then you look at, let's talk about Apple for a second, right? About 2 years ago, the stock was $97. Today, it's over $200. What happened in the last 2 years that made Apple worth twice as much as they are today? They're not selling twice the phones. If anything, their sales are declining, right? Mm-hmm. They haven't innovated anything new in the last 2 years, or anything since really Steve Jobs died.
Yeah. What have they done since Steve Jobs died?
They didn't cut the costs in half. So why is the company worth twice as much? And the answer is that it is not. It's just that the stock market lost any connections to the fundamentals that built the stock market. Right? It was designed for businesses to be able to raise money based on what the business is capable of delivering, what the revenue is, what the net profits are, what the multipliers are. And that connection has been lost completely, in my opinion.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So how then did you decide on multifamily, and why is it you think with multifamily you can control its value?
That's a great question. So I'm just going to take a quick run down through the other commercial niches, right?
Oh yeah, please.
To help show my thought process, right? You have retail, and to that I only have to say one word: Amazon, right? The big malls are dying. The big department stores are dead. They're not even dying; they're officially dead. The only retail that will remain and will endure is your neighborhood service, your hair salon, your nail salon, your things like that, where you get services, but you're not going to get. When was the last time you saw a small department store? When was the last time you saw a shoe store? Right? So that's really where major retail is going to have to go through some kind of a transformation to repurpose that space. But until then, retail is going to suffer. Office, once again, one word: WeWork. Right? The whole revolution of shared co-working spaces and working remote, and a lot of companies are moving into 4 days a week work, which means they can hot sit desks and they can reduce the space they consume in an office building. What else? Medical, same thing. I've seen a lot of situations where you see an office where you have one receptionist and one nursing staff, but 6 doctors work together. They have their own businesses. They all file against different insurances, but they share costs by putting themselves in one space. And what else? We covered retail, medical,
industrial?
office, industrial. Industrial is a very interesting space. It's the other asset class that I do believe still have a runway, just like multifamily. Because with the prevalence of e-commerce, with or without Amazon, most of these guys start in a garage and then grow out, and then they need a small industrial space, and then they need a bigger industrial space, And then the Amazons of the world, they need the massive industrial spaces, right? So I don't see industrial dying anytime soon. I actually think it's a great asset class to be in, just as much as multifamily. But that led me to multifamily because and the other asset class is land, but land is not designed for yields. Land is designed for appreciation. And I always try to find something that gets me cash flow, because appreciation is more based on hope, and hope for me is not a strategy. So multifamily, we're in the midst of a massive generational shift. We have baby boomers that are just tired. They don't want to do lawn mowing anymore. They don't want to clean gutters. They don't want to fix the dishwasher. They want to downsize from the big house into the small apartment. Kids are out of the house. I want to be able to pick up the phone and get somebody to come fix the dishwasher, right? Mm-hmm. And that's 77, 78 million, right? You have another 75, 76 million millennials that also have a strong preference to rent over buy for all their reasons, right? Whether it's they want to be free, their lifestyle of moving around, they want to follow the jobs, they have huge student debts, right? That they can't even afford to buy a house, right? So it doesn't matter what the reasons are, but they also have a strong preference to rent over buy. So you combine these two and you have a little over 150 million people. If you look at the United States, we have 330 million, give or take? Mm-hmm. Take away everybody over 80, take away all the kids, you're left with about 220, 240. So 3/4 of that population is those two generations that have a strong preference to rent over buy. That makes multifamily a no-brainer.
So you have a very strong demand for that type of multifamily rental.
Exactly. And not only that, right? It's going to be one of the last and hardest industries to disrupt, because it doesn't matter if you walk to work, fly to work, ride something to work, you still have to come back and go to sleep somewhere, right? You still need a home. You still need shelter. So moving away and disrupting the apartments industry is probably going to be one of the hardest things to perform.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. The disruption part, you see a bright future for multifamily apartment type rentals. What are some of the other ways that you like multifamily and that you're able to control its value?
Yeah, so that brings us to the conversation of multi versus single for a second, right? So let's say you live in a house somewhere in a nice neighborhood, suburbia, right? And that thing is worth $400,000. Well, if everybody on your street get crazy and decide to divorce each other, right? And everybody is selling out of necessity and they're selling at $350, guess what? Your home is now worth $350. And there is nothing you can do about it. You can put gold faucets and sprinkle diamonds in the backsplash. It's not going to help you, right? Because the way we evaluate single family homes is through the comps system, right? The appraiser comes in, he pulls all the neighborhood sales, and he says, okay, based on your comparable sales, you're going to be worth $350,000, and there's nothing you can do about it. In multifamily, the way we value things, and that's actually true to most of commercial real estate, you're dealing with investors. There's no emotional decisions there, and all the valuations are based on the numbers. So when an appraiser comes in, he looks at your income, he looks at your expenses, he looks at the area cap rate, and cap rate is determined by multiple factors, and a lot of them are macroeconomic factors like the availability of loans and what's the interest rate in the market and so on. So a lot of things that if it's out of your control, it's macro and it's not dependent on three neighbors, really. And the things that are in your control, your income and your expenses, really are the big factors in determining the value of your property. So, like I said, the formula is very simple. It's income less expenses divided by that cap rate, and that's the valuation. So because it's income less expenses, every dollar I increase in income impacts, but also every dollar I reduce in expenses impacts my value exactly the same way as the dollar I added in income.
Yeah, it's a very mathematical formula to help you figure out the value of the property. What are some of the factors that aren't under your control when it comes to multifamily?
The only thing is the cap rate. Really, you can't control the fluctuations of the Fed interest rates or the LIBOR or the prime, right? So anything, the 10-year yield on U.S. Treasuries, you can't control those, but you know that these factors impact everybody. So it's not just your property. So if the entire commercial real estate sector is going to get an increase of 1/4 point in interest rate, you will get it too, but so will everybody else, including your competition.
It was 2016 when you kind of went through all these calculations and decided that multifamily was the way to go?
15 and 16, yes.
So you had some duplexes, some single families, but now you have 500 multifamily units. How did you go from like 0 to 500 so quickly?
Yeah, so I like to describe this industry as a snowball on a roller coaster. And it's a funny way to look at it, but it's a snowball factor because the more you do, the more you get. It took me over a year to find my first property, and that included a lot of work, and a lot of the brokers didn't want to even pay attention to me and didn't send me any properties and so on until I eventually sourced it myself. But once I closed the first one, the second one came real fast, and then the third and fourth and the fifth. So it's really like a snowball. The more you do, the more opportunity you can see and get across your desk. And then the roller coaster factor is you can go by looking for a property 2-3 months and find nothing that fits your criteria. But then all of a sudden you have 4 under contract. And you got to figure out how you handle 4 under contract at the same time. So snowball on a roller coaster.
Yeah, and tell us a little bit about the markets you're investing in. I know you're in Texas, secondary type markets. Where are you?
Yeah, so most of our units are in a city called Lubbock in Texas. It's the home for Texas Tech, the university. And Texas Tech is one of the biggest engineering schools in the state. It's got a big football team, the Big 12 Conference, Red Riders. And the reason we love that city is, and I tell that to everybody that tells me, well, how do you pick a market, right? Well, there's only one factor that really is important in a market, and that is jobs. We're investing in the B and C class range, which means usually it's blue-collar employees, hardworking families, and young professionals. And a lot of these guys are living paycheck to paycheck. So if you're going to be in that environment, you got to be in a market that if your resident loses their job, they need to be able to find a new one within a week or two. Otherwise, they won't have the money to pay the rent. It's that tight and it's that important. So that's really why we went to Lubbock. We don't do student housing. There's over 37,000 students in the university. However, the math is very simple. For every 4 or 5 students the university adds, there's another job created in town. And that means that university sustains about 13,000 jobs in town, but $1.2 billion to the city's economic every year. They're definitely the big dog, but they're not the only dog in town. There's other major employers in town. So overall, the unemployment in town is usually about 2.5, 2.7, 2.8, which is always a full point below Texas, which is usually about a full point below the rest of the country.
So you like the fact that you have the university town and it creates a lot of jobs, and that's the primary thing you look at.
Yes, and when we went out to the secondary markets, basically because we got priced out of the main markets, we were looked at as, are you crazy? You're going out there? And today, everybody comes out to the secondary markets and they're talking about, oh my God, secondary markets is the hot thing. So we were there early, and we're pleased to be there.
Yeah, Grand Rapids, Michigan, that's where I'm invested. That's kind of the same thing. I mean, it was a tertiary market 10 years ago when I started investing here. Now it's a secondary market, and 10 years ago, no one was even looking here and thought I was crazy. And now it's a super hot market. Everyone is looking to get into it. So I know what you mean about that perception of secondary markets. It's really changed over the past 4 years.
Yeah, absolutely, and you see that not only in the single family world and multifamily. I'm a speaker for the IMN conferences, and I see how the narrative changes every quarter. Basically, when they have another conference, and I'm going out there, the big hedge funds, the big equity partners, they were not even willing to look at secondary markets about a year and a half ago. And smash cut to 6 months ago, everybody's looking for secondary market opportunities. So that's really where you got to find the right market. And if it's secondary, it's secondary, but you just got to find the right market.
Well, why do you think that is?
Well, there's still a lot of capital out there that is aching to deploy, right? And that requires them to be more creative. That requires them to go down on the minimum check they're writing. That requires them to compromise on what yields they're looking for. And the problem is that the main cities, at least in Texas, are just so bombarded with competition that a lot of them just get priced out of the market, and they start looking at, okay, where can I get better returns, lower risk, and that goes out to the secondary markets.
Has that caused you to consider selling any of your properties?
I'm not a big believer in selling real estate. It's real estate is a long game. If you're just flipping, that's a job. That's not an investment strategy. And no, we're not in a phase of selling yet. We're going to have to sell at some point because we have investors and we want to deliver the best value possible for them. But even then, that's going to be a voting decision, right? Our investors are going to vote if they want to sell or not. And it really depends on where we'll be in the cycle. But I would really like to ride the next downturn and be on the next cycle before we sell, because we use a lot the word cycle for real estate, and that is just not the right that's not the right term. Real estate is not a cycle. A cycle is when you always get back to zero and start again. In real estate, we get back to zero and then some, and then it turns, right? So if you look at the people that bought in 2006 at the top of the market, most of the places in the country that did that, they were back to zero around beginning of last year. And then since then, they kept going up.
When you say back to zero, back to where the value was when they bought it in 2006?
Yes.
Yeah.
And then the value kept going since last year, right? So now they're above what they were. So if you look at real estate, it's more like a staircase than a cycle. On a 5 to 7 year period, that looks like a cycle that goes back to zero. But if you look at a 10, 20, 30 year range, there's not a single property in the country that is selling today at the same price it was sold in the 70s or the 80s. There's just none. So if you play the long game in real estate, you're pretty much guaranteed to make money.
You're guaranteed to make money because overall the values are always going up.
Yes. Now, there's one caveat to that, And that is my entire real estate career. It doesn't matter if it's singles or multifamily. I always follow 3 rules. Right? Rule number 1 for me in real estate is you make your money when you buy. I can't emphasize that enough, right? If you overpay, you're basically are in one or two situations, right? And nobody can time the market. But if you bought in 2011 and you paid, let's say, 20% more than the property was worth, then the market have corrected since then, and you're doing just fine today. But if you'll buy today and you pay 20% more than it's worth, and the market turns on you next year, the market is going to take your head off, right?
Yeah.
And that's the thing. We can't time the market. I don't have a crystal ball. I can't tell you if the next correction is going to be next week, next month, next year, or 6 years from now. But the people that bought at the top of the market in 2006 did that because they saw the growth from 2005 that kept going from 2004, that kept going from 2003. They didn't have a crystal ball too. But you just got to be careful, because if you don't make your money when you buy, the market, and you're at the wrong time in the cycle, the market will take your head off.
So before you go on to your, I think you had three things. You make your money when you buy, but when you talk about the cycle or the staircase, I know that you and I don't have the crystal ball to say, okay, where are we in this market and when is it going to turn? But you do have like an on the ground perspective of what you're seeing around you. What are you seeing around you right now that tells you whether you should be cautious or whether you should be buying more properties?
Well, just because I don't have a crystal ball doesn't mean I don't have an opinion, right?
I know you have an opinion.
So I'm also a broker, so I have access to systems like ERD, and I can see property sales, I can see rent, I can see occupancy in our entire market, and I already see there is the beginning of the curve on the rents. Right? We've been pushing rents more and more and more and more until the point where the market says, I can't. And everybody, at least in DFW, had to take a step back in 2018 on the rent growth. So that's one thing. The other thing is there's a lot of builds. There's a lot of Class A property coming up all over the place, all over the country. And all that new product is going to have to be absorbed somehow. And they're still building. They're still breaking grounds every day. So I think that we have about a year to 2 years, somewhere in the 18 to 24 months left on this cycle. And barring any wild cards from our current administration, I don't see that extending. And that's just goes back to the same conversation we had about the Apple stock, is we're losing contact with the fundamentals. And that's really where everybody buys. I'll give you an example of what I mean when I say lose contact with the fundamentals. Rent in the Dallas area went up about 20-30% in the last 4 years. But wages only went up 2-3% a year. So you can keep buying and you can keep increased rent, but at the end of the rainbow, there's a human being that works at a job that didn't give him more than 2-3% raise a year, and there is so much he can afford before it becomes too much. So I believe in 2019, a lot of the conversations are going to revolve around affordability and who can rent those. And if you bought a property, let's say a C-class property, which is a very common value add strategy. You buy a C-class property, you renovate the units, you push the rents up, right? Mm-hmm. If you renovate all the units and you try to push the rents up and the market tells you no, then suddenly you have a lot of capital invested and no ROI to come cover that. So that's really where I see a lot of the people that overpay these days are going to face in the next 2 years. They're going to face that reality. A lot of them are taking loans that have interest only. And when that principal kicks in a year or two, that's also going to be a reality check for a lot of those. So that's really where I think the market is going to be very interesting in the next 3-4 years after all those reality checks hit a lot of people.
Yeah, because they're buying the B and C with upside value, but once they put the money into to improve those units and hopefully capture that upside rent, the market may not respond with people who actually can pay that higher rent. Is that kind of what you're saying?
Exactly, and it goes back to, if you want to look at it from the single perspective, if you buy a property in a neighborhood that everything rents for $1,100, and you do a little renovation and you can charge $1,200, that's awesome. But if you're gonna make, again, all the faucets gold and you put sprinkled diamonds in the backsplash, you're not gonna get your money back, because there's nothing you can do to that house in that neighborhood. Bless you. There's nothing you can do in that house in that neighborhood that will command the $2,600 rent, because everybody around you is $1,100.
So there are a lot of people right now who are investing in multifamily, investing in apartments, and are out there buying right now. What would you say to them? What cautions do you have, and what advice do you have?
Well, I'm one of those too, right? But I stick to my 3 rules, right? So we talked about the first one. You make your money when you buy. So don't overpay. Make sure you get a great deal. Make sure you can sustain whatever debt you're going to put on this property, right? The second rule is location, because that's the one thing you cannot change about a property. And I know a lot of people say that rule number 1 in real estate is location. That's not true. It's rule number 2. And then rule number 3 for me is buy for cash flow, because hope is not a strategy.
Buy for cash flow because hope is not a strategy.
Yeah, and if you stick to those 3 rules, they haven't served me wrong yet.
So when would someone be using hope as a strategy?
Anybody that buys in New York, Seattle, Miami, California.
Because what? They're hoping for appreciation?
Yes, that's the only thing that goes out there. If you buy something that is not cash flowing, right, or even breaks even, that means there will be a point in time where you're going to have to write a check out of your own pocket to cover that, right? So you're talking about zero cash flow and negative cash flow. If you're not hoping for appreciation, then why are you buying this then? You like losing money? Mm-hmm. So all of these guys are buying with the hope that a few years from now, the property will be worth more. But I'm not big on, I have a house that's worth $6 million, but I put $10,000 into it every day out of my own account. Right? It makes no sense to me. These things should be working for us, not we work for them.
Excellent point. I want to talk about your current situation right now with your management. And we had talked a little bit before the episode about how you're going through some management changes on your property. Why don't you tell us a little bit about that?
Yeah, so we're currently in the process of replacing our property management company, and it was mostly because we have one of our properties struggling, and I wanted to prevent the rest of them from getting to the same spot. So our property management had a few, let's just say, unfortunate choices in hiring. So one of the things that I'm very adamant about is taking care of our residents and making sure that I told everybody I don't want to be a slumlord. Don't make me a slumlord, right? And we had a few people on site that were just not treating the residents right, and they were not promoting a sense of community. They were not doing their jobs, basically, and that turns into retention issues. That turns into people not willing to renew their lease because they're not happy with living on your community. And something like this can escalate real fast into a problem, because when residents move out, you got to spend time, money, and effort and labor in order to turn that unit and get it ready for the next tenant so you can lease it up, right? So all of a sudden, you have a lot of capex showing up and you have a vacancy, but you still have to pay the mortgage, you still have to pay the salaries, and you still have to do the turnover to all those units. And goes back to what I said with my 3 rules: make your money when you buy. If I didn't buy these things at the right price, I would be choking under the debt. I would be negative under the debt. But even at the situation we're in, we were still able to pay the mortgage. We were still able to pay the rent. We were still paying maintenance, and we were still turning units. So that's really where it comes a full circle to that rule: is don't overpay, because if you overpay, the meaning of overpaying basically means your debt is going to be very high and you're not going to have a lot of margins to handle situations like this. And, there's not a lot you can do from the outside and not be on the property every day to know how your staff is interacting with the residents. So since then, we have placed a few mechanisms in place to make sure that we are aware and we do keep control over that. But that was a painful lesson to go through.
Yeah, it's interesting. A lot of people would think, wow, Joseph, you've got 500 units. You were able to acquire that. You're controlling over $30 million in commercial real estate. You must have it easy.
Yeah, well, if it was easy, everybody would do it.
Yeah. It actually gets kind of messy, doesn't it?
It is, and you got to be able to pull the sleeves and get in the trenches with everybody, right? So in the last 6-7 weeks, I've been almost every week I've been out there, and and our properties are about 5 hours away from me, and I'd spend 3-4 days on the property every week because I needed to be there. I needed to provide the guidance. I needed to provide the support. And I'm glad to say that we're already seeing a shift in momentum, and we're seeing the properties being functioning a lot better, and that struggling property is starting to lease up gradually. But it's a lot of hard work and it's a lot of dedication. And if you're not willing to do that, then it's not fair to take money from other investors and promise them rainbows and lollipops.
What were some of the decisions you made during this period that you feel are helping to turn these communities around, and the management that's in place?
So I think presence help, because the staff, first of all, okay, let's take a step back. We fired that entire staff that was not treating our residents right. And since then, presence helps, guidance help, being there and keep pushing the same message of take care of the residents. Take care of the residents. Make sure the residents are taken care of. The top priority is residents, right? You keep pumping that message in until it gets through. And you also help them understand that, look, if you don't treat the resident right, they're not going to renew the lease. That means you're going to have to get the maintenance people to do the make ready, which means more work for them. And you're going to have a leasing agent that's going to have to find a new prospect to come in and lease that unit. It means more work for everybody. But with just kindness and attention and taking care of the residents year long, it's an easy conversation. And within 30 minutes, you get a lease renewal. That's a lot easier than make ready and fixing and getting carpet scheduled and so on, and then leasing the unit. So I tell them, make sure your life is easier by keeping retention and increasing retention.
So when you talk about that one-on-one contact and just paying that extra attention to your residents, you're also a broker. So you have a lot of broker type relationships with clients. Can you talk about your business as a broker as well?
Yeah, absolutely. So we do only commercial, right? We don't do residential properties, and we focus on multifamily, even though we have agents that have a lot of experience in retailers and so on. And the idea is that we have some added value, right? As a small shop, we're not one of the big ones out there, of course. We offer a full 360 degrees perspective, right? We are owners, we are operators, we are asset managers. We've worked with lenders and investors to raise equity. So we can help with any hiccup that shows up during the transaction. What a lot of the big firms out there are hiring fresh grads and younger agents that really don't have the real perspective. And I find it kind of funny that I'm looking usually on the offerings from other brokers, and they put 1% economic vacancy, and it's kind of like, well, life doesn't work this way. And if you owned a property or operated a property, you would know that. So that's really where we have a little bit of added value, and we work with our sellers and buyers to get transactions off market, right? Get transactions done without the big circus that I call it the blender, right? The big agencies will get you through the blender. There will be 30, 40 tours. There's going to be a call for offers. There's going to be a best and final. It's going to take 6 months. Probably the first 1 or 2 contracts will fall through, right? It's just a lot of impact and disruption to the property. And the way we like to do things is a lot quieter and a lot faster through our private buyers and sellers. And that's really what we do.
So are you, for listeners to the show who might be interested in your services, are you working both with buyers and sellers? So if you have a commercial property that you want to sell, they could come to you and maybe get some off-market type offers. And then on the opposite end, if you're a buyer, would you want them to contact you as well?
Yeah, we work both with buyers and sellers, and the idea is that we qualify the buyers for our sellers, and when we talk to our buyers, we understand what their needs are, what their experience is, what they can and cannot do, and we make sure that when we have an opportunity that fits their profile, we get them a sneak peek before the rest of the world gets to see our transactions, right? And that's really what I was saying earlier, trying to keep these transactions quiet and fast, only with our own internal database.
Yeah, and I like what you said about how you look at other brokers' pro formas and they might have a 1% vacancy factor or whatever. I think the fact that you own and manage multiple units, over 500 units, means you understand the messy reality. You know what the true costs are going to be.
Yeah, and it goes beyond what reality is. It also goes beyond to what you want as an owner. Right. So one of the factors is loss to lease, right? The difference between market value and what your actual rents are for. And a good owner operator knows that you want a healthy gap there, right? Because if all your units are at maximum possible market rent, it probably means you turn over units all day long, right? If the market rent for a unit, let's say, is $800, and I can renew a lease at $750, I'm not gonna get that resident out. I'm gonna let it rent it for $750 because for $600, which is $50 a month for a year, I can't take that unit and renovate it. So if I'll take him out for $50 a month, I'm losing money. So there's always going to be that gap between market rent and actual rent, and I always want to keep it there, and I want a healthy, let's say, 2-3% difference over there.
Yeah, that makes perfect sense. As we wrap it up here, I've got a couple more questions for you. And I want to ask you, I'm always impressed by when I have guests on who have military service, and you were in the Israeli Defense Forces. And in Israel, being in the military, that's compulsory. Is that correct?
It's mandatory, yeah.
Mandatory, yeah.
And most people in Israel are in the mandatory service, and men are mandatory to do 3 years. Women do 2. And if you want to be an officer, that's an extra year, at least.
And you were a lieutenant. So let me just ask you, I mean, what did you learn from that experience that you are able to apply when it comes to commercial and multifamily investing?
Yeah, so there's a few. That's really a good question. I have never been asked that, but there's a few things that military service really helps with, right? Being an officer, leadership skills are critical. So being able to command platoons as big as 100 people and running things and taking care of the people, because it's a people real estate is a people business, and being an officer in the Army is also a business, not a business, a people task. So you got to take care of your soldiers. You got to make sure everybody's taken care of, that they all have their own problems, their own families, their own situations. So the leadership skills I got from there were immense. The other thing is, in Israel, the mentality, the situation, the environment does not allow you to procrastinate, right? This is all a let's get this thing done mentality. So obviously military has a lot of that in any military, but definitely in Israel, it's a little bit more critical. So I also got the get things done mentality, and you combine the two of the last thing that I just said, you come out with basically lead by example. You come out with, okay, if I need to pull my sleeves and help my soldiers do something, I pull my sleeves and help my soldiers do things. And I keep that mentality with me until today, because just last week I did a Walmart run for the property. Right, I went to Walmart and I bought a bunch of stuff they needed, because, nothing is beneath me. I'll do whatever it takes. If I need to take a paintbrush, I'll take a paintbrush and we'll paint something. So that's really where I learned that from the military and being a commanding officer. And I was also in logistics in the Army, so that obviously gives me my own little knack for details and getting things organized and systems and automated. So that's a big help too.
Ah, great. Well, Joseph, how would people get a hold of you if they're interested either in your brokerage services or your investment opportunities?
Yeah, so it's very simple to find me. You can just Google my name and I'm everywhere. But my brokerage business website is ebgtexas.com. And my acquisition business is ebgtx.com. Very simple to remember. One is with the full word Texas. One is with just a 2-letter abbreviation.
All right, and I'll make sure that's in the show notes as well. I want to thank you for taking the time to share your perspective on commercial multifamily investing and just taking us through kind of the thought processes that you go through when you make an acquisition and what you look for. So thank you so much, Joseph, for being on the show.
Appreciate it. Pleasure was mine.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.